Hey everybody, today we're going to do another case study, and today we'll be assessing the financial health of Dr. Larson, who just purchased a practice, and his wife, Laura. And top of mind on the Larsons' minds is the questions of, they're starting to see the practice generate some good cash flow now, plus Laura's income from working, and they're wondering, what do they do with the extra cash flow? What's the best next thing to do with the dollars that they're earning above and beyond their expenses? And should they be putting it towards investing and saving? Should it be going towards paying down debt? If it should be going towards investing and saving, which account should they be using? So what's the next best way to use this extra cash flow that they now have in their life? And so let's go through a quick financial health assessment and talk about some potential next steps. And what we're seeing right now are their financial vital signs. So similarly to how you might look at the ocular health or eye pressure or acuity of a patient, each of these tiles, these scores, is a vital sign or health score about different parts of their finances. And what we generally want to look at is, okay, are they in healthy or typical ranges? Are there any places for improvement we need to look at? And if so, what's that next action step we should be taking? So just like any vital sign, these give us a really quick way to assess financial health and to see what next actions should we take and what areas do we need to dive in deeper. So for the Larsons, the first thing that jumps out at me is how they're using their cash flow right now. If we look at these tiles here, the first four tiles talk to me about where their cash flow is going. And what they tell us is what percentage of their income is going towards saving and investing here with savings rate, spending here with purple, a debt with the debt rate in the green, and then taxes in the yellow. And when we look at the spending's actually quite reasonable. They've done a really good job as they've prepared for the practice purchase to keep their lifestyle pretty reasonable. The debt rate though is at the higher range, is at the higher end of what we would consider a healthy range. Typically, a typical range for debt in total is somewhere between maybe 20 to 30% of your income, total combined debt payments. And of course that can skew depending on where you're living and housing costs and things like that. But at 28%, they're already sort of at that higher range of the higher end of that healthy range, which is not surprising because they have the trifecta. They have student loans, they have a mortgage payment, and they have practice debt. So it's not surprising to me. It's not unhealthy, but it's definitely at that higher range. Tax rate's a little bit high. That might be something we want to look into to see if we can manage that a little bit better. But the savings rate really stands out. Savings rate is considerably low. If we look at their story, they did a really good job of building some liquidity for this practice purchase and to qualify for the debt. But then they basically stopped saving. They shut off the valves altogether. So savings rate is considerably low. Usually as like a long-term target, I'd want to see somewhere between maybe 15 to 20%. So savings rate is low. The other thing that stands out to me is in this orange here, liquid term. These four tiles here, liquid term, QT, qualified term, real estate term, and business term, those talk to us about what mix of assets do they have in their net worth. And I can see, is that a healthy mix? Is that a healthy mix? This liquid term tells us how much liquidity they have in their life, whether it's cash-like things or taxable brokerage accounts, things that are liquid that you can get access to tomorrow. And as a now practice owner, liquidity to me is super important. I value liquidity both in the practice, making sure there's enough cash and liquidity in the practice, and also in the household. And so what this score is telling you is basically how many years or months, in this case, how many years could they live off of the liquidity in their life based on their current spending. And at 0.4 of a year, that's definitely low to me. That really stands out to me as something that we might want to improve. So when we go back to their questions of where should the extra cash go, should it go to saving and investing or debt payments, knowing that the debt rate is already at the higher range of healthy, I probably wouldn't right away, unless the interest rates were extreme, consider adding on additional debt payments and increasing that further. If we knew that the interest rates were reasonable and it's productive debt, I would probably leave that as it is for now. But we definitely want to try to improve this savings rate. The question is, where should it go? Well, we also know that the amount of liquidity they have is pretty low. That's something I feel like we really want to address and to try to improve. So it will probably make sense to have a balance between the 401k account in the practice and towards whether it's cash to build up a cash reserve or just a taxable investment account, which I think are underutilized, underappreciated. We definitely want to take a balance there to build up flexibility and build up liquidity. I think the cash flow management in the practice is another thing altogether that I think we should have a conversation about. How are they looking at how much cash is in the practice? Where's it going? Are they setting aside money for taxes and debt payments and filling up the appropriate reserve in the practice, preparing for the next appropriate investment in the practice? So just looking at cash management and savings in the practice too. So that's the way I would sort of look at that. Another thing that stands out is this insurance rate, which is blank, which means they either don't have insurance or more likely they probably just haven't entered anything. And now that they've had this big life event happen, right, this business purchase, definitely want to review whether they are properly insured and tackling the big risks in their life, whether it's life insurance, disability insurance, umbrella insurance for liability, whatever it may be. We'll want to take a look at their insurance coverages and ultimately go from there. So that's a quick health assessment. Hopefully that's helpful for you in terms of thinking of your own finances. If you want your own health assessment, here's what you can do. You can go ahead and just click on the link below in the comments in this post, or scan the QR code that's popping up here. And all you would need to do is go to that landing page, download the Elements app, take a few minutes to fill in your own score here, and then I will send you a video assessment, personalized video assessment, to talk about your scores, what they mean to you, and maybe some next actions you should consider taking. Hopefully that's helpful. With that, that's the end of the case study. Have a great rest of your weekend and take care.